Nicole, I've been reading through reports on a handful of recent earning calls that had some interesting views around AI and AI spend. Analysts weren't just asking whether AI spending was going to pay off strategically. They were actually asking CFOs to explain on the record how the economics actually work. So how it's being accounted for, how it flows through the financials, and what the return profile looks like. And that same conversation is happening in boardrooms too, just with the cameras off there. PE sponsors, audit committees, boards, they're all asking versions of the same question. Show me how this investment is being treated and why.
And that's a legitimate question to ask. And it's harder to answer than it might seem, not just from a communication standpoint, but because the accounting itself is genuinely complex. So whether AI development costs land on the balance sheet as a capital asset that gets amortized over time, or they hit the income statement as incurred, produces meaningfully different numbers. And right now, companies of every size are having to make that determination on investments that are, in a lot of cases, material.
Yeah, and at the high end, you've got your four largest hyperscalers, right? Your Amazons, your Alphabets, your Microsofts, Meta, are collectively tracking towards somewhere between 650 and 725 billion, that's with a B, in combined CapEx for 2026. Nearly double what they spent last year if you look at it. Their CFOs are out there telling investors that this spend is all disciplined, it's demand driven, and it's ultimately going to be margin accretive for those businesses. And that's a hard story to tell when the accounting framework underneath wasn't necessarily designed, I think, for what AI development actually looks like today.
And what gets lost in the hyperscaler conversation is that this is not a big tech problem. KPMG recently published survey data showing companies broadly are planning on an average of $186 million in AI investment over the next 12 months. Baker Tilly put out mid-market numbers, so companies in the $200 million to $2 billion revenue range, showing nearly 6 in 10 are actively investing in AI this year, with average spend over $600,000. Those CFOs or controllers are sitting across the table from their boards, having the exact same conversation. How are we accounting for this, and can we defend it?
Yeah, so whether you're defending $200 billion in CapEx to your Wall Street analysts, or you're walking your audit committee through how you treated, $2 million of model development project costs, the underlying accounting questions are ultimately the same. Which standards apply, what can be capitalized, what has to flow through the P&L, and then how do you document it all in a way that holds up to audit scrutiny?
And the standard setter just weighed in. The FASB issued 2025-06 last September, which is the most significant update to internal use software accounting in years. That alone tells you something. Standard setters don't rewrite guidance unless the existing framework is producing bad outcomes at scale.
Yeah, so we've got a lot to comb through here today. So welcome to Accounting Matters. I'm Adam Olsen, joined by Nicole Harger. So let's dive right in. So let's start at the beginning, which is kind of a redundant statement now that I'm saying that out loud. But this is really the step that I think a lot of finance teams shortcut. And that's not without consequence. So before any AI-related cost can be capitalized or expensed, you have to figure out first what accounting framework actually governs the project. And that answer ultimately is going to drive everything downstream.
And it's genuinely not a one-size-fits-all. What we see fairly often is companies defaulting to their existing software capitalization policy and applying it across all AI spend without really stopping to ask whether that policy fits what they're actually doing.
And sometimes it does fit.
Right, sometimes. But AI initiatives vary enormously in purpose and structure, and the accounting treatment varies right along them. So get it wrong at the framework selection stage, and you've created a mismatch that's genuinely expensive to untangle once you're sitting in an audit.
All right, so let's maybe walk through the different buckets or frameworks of guidance that exist today. So the most common situation for finance leaders today is internal use software. So AI tools built or acquired to operate inside the organization. That's going to fall under ASC 350-40. And internal use is actually broader than it sounds, right? It also covers hosted AI applications delivered to customers on a SaaS basis.
So if your team is just accessing a generative AI platform through a browser and never actually touches the underlying code,
that's almost always going to push you into a 350-40 analysis. And it matters because 350-40 has real capitalization pathways, right? It's not always going to be expense. There is a window under current guidance where eligible direct costs can go on your balance sheet. And we'll get into the mechanics of that later in the conversation today.
So what about a company actually building AI to sell externally, an AI-powered product?
Yeah, so different framework there entirely. That's going to fall under ASC 985-20, which again, that governs externally marketed software. And the capitalization under that guidance is materially higher, if people will recall. So everything's expensed as R&D until you hit that technological feasibility standard. And the standard defines that as completing all the planning, designing, coding, testing, etc., necessary to confirm that the product can be produced to the specifications.
Which in practice means pretty late in the development cycle.
Right. And most software companies use kind of the working model threshold, and that occurs very late in practice, right? So most costs end up getting expensed regardless of how big the investment actually is. And I think it's also worth flagging 985-20 wasn't touched by the FASB and the new ASU that we'll touch on later today as well. The FASB focused on some changes, but it really related specifically to internal use software only.
Yep. And then the third bucket, AI developed purely for research. That's going to fall under ASC 730. So you're expensing as those costs are incurred. There's no capitalization pathway and no optionality. The purpose of the work governs the treatment, not the size of the check.
Yeah, so the framework question really does have to come first.
Yeah, most certainly. And then underneath all three of those buckets is a whole layer of ancillary costs, hardware, data, cloud infrastructure that don't necessarily follow the same standard as the software itself. So Adam, that's where it gets genuinely messy operationally. What does that actually look like for a finance team trying to manage it?
Yeah, I think it's interesting because you can have a single AI initiative that could ultimately touch 4 different standards simultaneously. And that's not going to be an exception. I think that's more common than most people realize. So for example, you could have GPU infrastructure that's capitalized as PP&E under ASC 360 guidance. You could have cloud arrangements that have embedded leases that are going to have to fall under the lease guidance in 842. You got data licensing. It has its own analysis under 350-30, which we're going to give its own segment later today because it is a large cost driver and one that's often overlooked when it relates to AI projects.
And so the cost tracking infrastructure has to be built to capture all of that at the project level from day one.
Yeah, exactly. It needs to be tagged to the right framework. You want to have it documented contemporaneously. That's not something that you can try to retrofit after the spending's already starting to happen. You really got to get it on the front end.
Right. And I think that's a gap we see most often. The accounting position is defensible conceptually, but the documentation to support it under audit scrutiny just isn't there because nobody built the tracking system before the spend started. And that's a theme we're going to most likely keep circling back to.
All right, so let's go deeper then on ASC 350-40 because this, I think, is where most of the day-to-day work is going to happen and have to be thought through. So just as a refresher here, the framework organizes costs around 3 development stages. And the stage a project is in when costs are incurred ultimately determines whether or not those costs are capitalized or expensed.
And I want to flag something before we talk through those 3 stages. It's easy to treat the stage determination as a one-time judgment at kickoff and move on, when in reality it's not. Costs incurred 1 week might be treated differently than costs incurred 2 weeks later if the project has crossed a stage boundary in between those 2 weeks.
Yeah, that's a great point to bring up, which means then finance has to be tracking this continuously, if you will.
Yeah, absolutely. And then that requires real-time communication with the technical teams actually running those projects, which most organizations just don't have set up. So walk us through it. What does stage 1 actually look like for an AI project?
So stage 1, as a reminder, is the preliminary project stage. So this is where conceptualization, technology evaluation, architectural designs occur. So for AI, that's evaluating things like build versus fine tune, defining maybe even the model's purpose. Scoping your data requirements is another example, running early proof of concept work. All of those things are expense as incurred. There's no capitalization in this project phase, and there's no optionality around that.
And this stage tends to run longer for AI than traditional software, right?
Yeah, what we're seeing and what we hear from people is it's running significantly longer. So you might spend anywhere from 3, 4, 6, or even 7, 8, 9 months in the early experimentation before management's ready to commit to a specific approach. All of that time is in the preliminary stage, and regardless of how much money is flowing through it, the dollar size is not going to pull you into stage 2.
Right. And that's an important distinction because with conventional software, you move from requirements to design to coding in a fairly linear sequence. AI development is way more iterative. You might run dozens of experiments before landing on the architecture you're actually committing to. And so finance teams need to hold that line and resist the pressure to capitalize early just because the numbers are getting big.
Yeah, which is tough, right? But again, the stage governs the accounting under the 350-40 model, not the size of your spend.
Exactly. So when does stage 2 open and what's actually on the table once you're there?
Yeah, so stage 2 is the application development stage, and this is your capitalization window. It opens when management's authorized the project and has committed resources to see it through. Once you're here, eligible costs can be capitalized. So your direct labor for people that are actually doing that work, incremental training compute tied directly to development. If you're using external developers, the cost of them, and specific to AI, also licensed data with no alternative future use if it's incurred during this specific window. And we'll dig more into those data costs separately because that's got its own layer of complexity that we need to spend some time with too.
And the indirect side of this is where a lot of companies have exposure they don't fully recognize. So let me spend a second on it. Indirect costs are never capitalizable, and that includes some costs that genuinely feel like they should qualify. So your facilities allocations, depreciation on shared servers, infrastructure as the service fees for compute that isn't exclusively dedicated to the development effort.
Yeah, and I think that last one's one of the tricky ones there, right? Because AI infrastructure almost never serves a single purpose.
Right. And so GPU cluster running development training in the morning and production interference in the afternoon is not a direct cost of the development project, at least not in its entirety. So in order to capitalize any of it, you need either physically dedicated infrastructure or a real tagging and allocation methodology that tracks compute at the project level in real time, not estimated after the fact.
Which means finance then needs to collaborate strongly with, engineering or IT, kind of spinning up those infrastructures, not 6 months later or in the heat of the audit when you're trying to reconstruct allocations under that pressure. And that's frankly where the real audit friction shows up, right? Companies that build the cost tracking capabilities before a major AI initiative are in a completely different position than the ones that are reconstructing it after the fact. The documentation tells a different story depending on when it was created. All right, so let's then move on to the last stage. So stage 3, post-implementation in the current internal use software guidance. So once the software is substantially complete and ready for its intended use, capitalization is going to stop. And this is the point at which amortization starts. So capitalized costs at this point, then again, are amortized over that estimated useful life. And then that asset's going to be subject to ongoing impairment guidance and assessments, which, if you think about it, is not trivial for AI assets, given just how fast technology is moving in that space.
Right. And there's a recurring judgment call here that comes up consistently. The line between capitalizable enhancement and maintenance expense for systems that are continuously retrained. So retraining that adds new capabilities is an enhancement, potentially capitalizable. Retraining that just keeps the model current is maintenance, which means it's expensed as incurred. So drawing that line requires technical input from engineering on a regular cadence. It's not a year-end exercise, and it's not something that finance can determine alone. Before we move on to the new ASU, let's make sure we give data costs the attention they deserve, because this is a layer of complexity sitting right on top of the software framework, and it's consistently underestimated. Data is frequently the most significant cost driver in an AI project, and it just doesn't fit neatly into the software cost model.
Yeah, and that's candidly because GAAP doesn't actually have any specific guidance on accounting for data.
Right. You're really applying general and tangible asset principles under ASC 350-30 alongside the software guidance, which means a lot of judgment from first principles.
All right, so help us out here, Nicole. Where do you start then with that analysis?
So I think the first question is how the data was obtained. The licensed data acquired through a contractual arrangement is capitalizable as an intangible asset under ASC 350-30 because it arises from an identifiable contractual legal right. You recognize it at cost, amortized over a useful life. Internally generated data, so your own proprietary transaction or operational data, is generally expensed as incurred because there's no contractual right underlying it.
Yeah, and then I imagine there's the alternative future use question, which I think is really kind of the crux of the whole analysis. So how does that then play out here?
Yeah, it's the single most important judgment in data cost accounting. If the licensed data has other uses beyond this specific AI project, you're going to use it for analytics, reporting, or other model development. It gets capitalized under 350-30 and amortized, typically as an indirect cost sitting separately from the software asset. But if the data has no alternative future use, meaning it's licensed specifically and exclusively for this project, it follows the software development timeline. So it's capitalizable during the application development stage, and then it's expensed if the project's abandoned.
Yeah, and I think that distinction could be a meaningful balance sheet difference when data licensing costs are so material, which, as we know and we see in AI projects, they often are. I'll also add it's a real input into how agreements get structured too. So finance leaders who understand this alternative future use framework can actually influence agreement terms, I think, in ways that could affect the accounting, which more or less means that the conversation needs to happen, like in many things we talk about on this podcast, before contracts are signed, and not as something that you're trying to address post-close as an accounting exercise.
Exactly. And then there's a timing wrinkle on top of all of this that also doesn't get enough attention. Data licensing agreements often span multiple years, with new data delivered in tranches. So costs under a single arrangement might be treated differently depending on where the project is in its life cycle when each tranche lands.
Yeah, so to clarify, so a delivery during the preliminary stage would get expensed, but then the same type of delivery, let's say 6 months later during the application development, might be capitalizable.
Right, depending on the alternative future use analysis. So tracking that requires systems designed for it from the start, and auditors are paying real attention to this specifically now because the dollar amounts have gotten material and the judgments are substantive.
All right, so let's maybe turn to ASU 2025-06 because this is where guidance is actively changing. So just a refresher on this new standard that came out last fall. So it was issued by the FASB in September of 2025. And just to level set here, it's effective for fiscal years beginning after December 15th, 2027. So said more easily, for calendar year-end companies, that means it's effective in 2028. Early adoption is permitted.
And the core problem the FASB was solving is worth understanding because it explains the shape of the new framework. The existing model was designed for waterfall software development, linear phases, clean handoffs, and a defined sequence from design to coding to testing to deployment.
Yeah, and which just isn't how companies build software anymore, like we said earlier.
Right, not at all. Agile development, continuous iteration, compressed sprint cycles. The stage model was creating artificial accounting distinctions and inconsistent outcomes across companies that were doing essentially the exact same things. So the FASB scrapped it entirely and replaced it with a principles-based framework. So Adam, what does that actually look like?
Yeah, so now, or I say coming soon, the new standard introduces 2 capitalization conditions instead of the 3 stages that we talked about previously. So under ASU 2025-06, you begin capitalizing when both are met. So management's authorized and committed to funding the project. That's the first one. And then second, it's probable that the project will be completed and used for its intended function. That's the entire framework. There's no preliminary stage, there's no application development stage, no post-implementation stage to think about anymore.
So that sounds cleaner on its face.
It does, but
there's a significant catch buried in there, and it's especially consequential for AI. So the FASB introduced this concept of significant development uncertainty as a barrier to that second condition, the probability of completion. So even if management has fully authorized and funded a project, if significant development uncertainty exists, you can't treat completion as probable until that uncertainty is resolved.
All right, so I'm going to ask you then. So what counts as significant uncertainty? Can you walk our listeners through what that looks like?
Sure. So there's 2 situations per the standard. The first, the software includes novel, unique, or unproven function whose uncertainty hasn't been resolved through coding and testing, or a significant performance requirements are unstable or haven't been agreed upon. And so for AI projects, both of those are extremely common early on. You have novel architectures, experimental training approaches, performance targets that shift as you learn what the model can actually do.
Yeah, so then for AI, that uncertainty concept isn't necessarily just an edge case.
It's often the central question. So Adam, what does that mean practically? When does capitalization actually start?
Yeah, so if I think about it, for a lot of AI projects, honestly, it's going to be later than under current guidance. Like right now, the window opens when management commits to a specific design, which can happen, relatively early, and that could be even before the technical path's been fully validated. But if I'm listening to this new standard, if significant development uncertainty still exists at that point, you're still in expense territory, regardless of how clear the commitment is. So capitalization doesn't start until that uncertainty has been resolved through actual technical work on the project.
And that's a real shift for companies with active AI pipelines.
Yeah, it is. And I think it's something the transition analysis companies will have to do needs to capture carefully, especially for those in-process projects, not just new work after adoption. I should be clear, though, on what doesn't change under the new standard. So the eligible cost categories, those remain the same. So your training costs and data conversion and maintenance costs, those are still going to continue to be expensed like they are today under current guidance. The capitalization period still ends when the software is substantially complete. That will not change. And then again, we talked about it kind of at the start of the podcast here, the externally marketed software guidance. So the ASC 985 guidance, they didn't touch it in this new standard.
It's also important to note the documentation requirement doesn't go away. If anything, it actually intensifies because now the judgment centers on management authorization and the uncertainty resolution, and both of those are needed. You need evidence to support those.
So what does that then look like in practice? Tell me operationally what companies should be doing.
Yeah, so I think ideally, you need to have formal checkpoints built into the development governance process. So moments where technical leads assess and document where things stand on the uncertainty question. And that documentation does double duty. It supports the accounting determination, and then it also creates an audit trail. If it's reconstructed after the fact by finance, it's going to carry a lot less weight.
Yeah, and then on the transition front, there's three approaches that are outlined in the ASU. So you've got a prospective option, a modified prospective option, and then retrospective. And the right one for you, I think, depends on a couple things. One, the volume of projects, and then I think also the nature of those in-process projects that you have at the adoption date. And just walking through how each of those might work. So the prospective approach leaves existing capitalized costs alone and applies the new rules only to new spend moving forward. Simple, but I think a failing in-process project is just going to sit there subject to impairment testing rather than getting cleaned up if you think about that approach. So something to keep in mind. The modified perspective does the same thing, except it adds a little bit of a safety valve. So if a project clearly fails the new test but passed the old one, you write it off directly to retained earnings instead of running it through your P&L as an impairment charge. And then the last option is retrospective approach, which again, right, it's a full look back here. So you're going to recast prior periods as if this new guidance applied always, with any difference landing in retained earnings at the earliest period presented. This is going to produce the most comparable results across all the periods, but if you think about just the implementation effort, it's got the heaviest lift. So bottom line here, prospective, if you think about it, maybe least disruptive. Modified, if you've already got projects you know will fail, maybe the new guidance. And then retrospective is probably the avenue you want to take if comparability matters most to your investors.
And then your disclosure requirements expand as well. Under ASC 360-10, those requirements now apply to all capitalized software costs, no matter how they showed up on the balance sheet. And then I think beyond the minimum compliance piece, maybe proactive disclosure about the economics and the expected returns of significant AI investments is going to be increasingly what sophisticated investors want to see. So companies that tell the story clearly are going to be in a better position than ones who are more vague about it. All right, so let's zoom out and talk about what this means for corporate finance more broadly, because the accounting treatment isn't just a reporting question. It obviously has real downstream consequences for budgeting and forecasting and how you measure those investments over time. And then also how you talk about AI strategy to your board.
Yeah, and the most immediate tension is the capitalized versus expense trade-off and what it does to the income statement. Capitalizing obviously defers the P&L hit, so near-term earnings and EBITDA in that scenario are going to look better, but it's not free, right? Capitalized costs create ongoing amortization that you have to forecast for. And then if you think about it, if a project's abandoned later down the road, or in the case of AI, if that technology goes obsolete early, the write-off hits the income statement immediately and in full.
And the write-off risk deserves more weight than it usually gets. So Adam, how do you think about useful life assumptions for AI assets specifically? Because that does feel like a place companies could get caught up with.
Yeah, that's a good point to raise, because I think it's a real exposure that often gets underappreciated. So the pace of capability improvement in AI, I think, is unlike anything that we've seen if we look back at just conventional software. Mm-hmm. So an asset that's capitalized today on, let's say, a 5-year useful life could be economically obsolete really in 2 to 3 years if a materially better model shows up, right? And that assumption can't be set once and forgotten. It needs to be something that finance teams are looking at regularly. It needs to be built in partnership with your technology leadership and revised, I think, as you are watching the landscape shift and keeping an eye on that landscape. And then the downside is a write-off hitting at exactly the wrong moment, right? And that happens faster, I think, in AI than in almost any other asset category.
Mm-hmm. And the build versus buy versus license decision is another place where the accounting should be an input to the decision, not something that gets explained after the fact. Building proprietary AI under 350-40 does create a capitalizable asset, whereas licensing API access is typically a period cost through OpEx. Buying a platform outright might be a capitalizable intangible asset, a SaaS expense, or a hybrid, depending on how it's structured.
Yeah, so finance could actually shape then, I think, how these deals get put together.
Exactly. And that's a seat at the table finance should be occupying early, not reactively.
Yeah, and then the FP&A side matters too. I think most AI budgets are still built the traditional way that software budgets were, and the cost structures then again aren't going to map cleanly. So a better approach companies may want to consider is structuring AI budgets with categories that actually line up with the accounting treatment. So direct development labor, licensed data segmented by use, dedicated infrastructure, shared infrastructure, post-deployment maintenance. That gives FP&A a much more accurate model, I think, than of the true life cycle economics.
And then the auditor relationship kind of ties all of this together. They are paying significantly more attention to AI capitalization positions than they were even a few years ago. The amounts are material and the judgments are substantive. I think this is a good spot to maybe kind of bring it home. If you're a finance leader with AI investment on your plate, where do you actually start?
Yeah, so I think advice we would give is let's start with the inventory. So map every active AI investment to the applicable accounting framework. I think you need to pressure test whether the current treatment that you're using actually matches what the current guidance dictates. Because I think that exercise almost always surfaces some gaps, and that's important to identify before they become audit findings. Then you also need to build the infrastructure. So the cost tracking systems that we've highlighted that capture direct development costs at the project level, allocation methodologies that can withstand scrutiny, cross-functional protocols like we've talked about, bringing your finance teams, engineering teams, IT, et cetera, together on those authorization events, and then even like going through those uncertainty assessments that we highlighted. And you don't want to necessarily wait on that ASU 2025-06 readiness just because 2028 might seem still a distance away. I think it's important still to assess which in-process projects would be affected by the new standard.
Yep.
You need to evaluate your transition approaches, maybe even think about early adoption, perhaps, and then also thinking through disclosures. And I think the companies that navigate that transition really well aren't going to be the ones that start late into 2027.
And the through line across all of it is that AI accounting isn't a back office exercise. It really does shape the income statement, the balance sheet, the board conversation, and how investors read your AI strategy.
Yeah, I couldn't agree more. And honestly, I think this whole space is going to keep moving between maybe the FASB's next moves and even just how fast the technology itself is changing. I'm pretty sure we'll be revisiting this topic in the future.
Yeah, no doubt. This was a fun one to dig into.
It really was. And I think that's going to put a pin in it for today's episode.
All right. Thank you so much for listening, everyone.
Yeah, we'll see you next time on Accounting Matters.